Now for our keynote speaker of the day, Rob Murdoch. So Rob is a geologist by trade. He's got 56 years of professional experience, nearly twice as long as I've been alive. Not quite, but nearly. From running exploration, feasibility studies, and mining projects, from junior to tier 1 projects across numerous commodities and countries. Rob has operated as CEO and chair of ASX, TSXV, and AIM Listed Companies. He retired in 2017 and has since developed a popular daily review of all ASX Resource Project announcements. Raise of hands, anyone that follows Rob on the ASX news? Holy Rob, you got some fans in the room. I wish you can see that. Rob couldn't be here with us today, but we have the pleasure of him joining us online, so I'll hand over to him now. I'll bring him up on screen right now.
Good morning, everyone over there in Perth. I hope it's a great day. Much for that, and thanks for the opportunity to talk to you all over there in Perth this morning. Just basically, I set up Austex as a way of, with the support of the Australian Stock Exchange, or at their push, I guess, as a critical review of from the project side. You'll probably seen lots of documentation that comes from stockbroking groups pushing stories on various projects, but we look at it from another point of view. We're not related to any organisation, so we're looking critically at what really is that project announcement telling us. So in other words, we take it's spin 3 and it's honest. Basically, what I've done today is, I know you're going to have a discussion later in the day, so I've prepared a lot of slides that hopefully will prompt some conversations in that discussion. Firstly, looking at how the average gold share price on the ASX companies has gone over the last year. You'll see that there was a jump up in the blue line in September, and since then it's sort of drifted back, and then it's taken off a little bit in the last couple of months. But what is impressive is the red line. This is just the gold companies, their average share price, and you can see it's still going up. So as most of you will know, gold has really dominated the exploration scene at the moment. This slide is a little bit out of date. I didn't have time to update it, but to the end of April, the 12 months, you can see that there's been a 13% increase in the number of companies focused on gold. That number has gone up even further since. Not such a big percentage because gold companies dominate the ASX market. There has been interest in of more recent time in antimony, cobalt and scandium projects as well as zinc, lead and gallium, uranium and copper have been the big improvers for the year, with the losers being nickel, lithium, coal and iron ore in the numbers of companies in each commodity. If you look at the best performed 12 gold stocks, actually it's not necessarily gold, is it? No, not necessarily gold, I don't think. Oh, no, yes, it is. It's all gold. Sorry, all best performed gold stocks for this year to date. What have they been doing? Well, the ones in a sort of greeny blue colour, about 4 of them have attracted market attention through drilling results. This is a little bit lower than it was. 3 of them have gained support from mine permitting. In particular of note was Datamine, who had President Trump come out and say, we're going to get this mine going, after years of the state authorities in California stopping the permitting of this mine to go ahead. The story a little bit like McPhillamys in New South Wales, but I'm not sure that we're going to get Albo to do a Trump on that one, but would love to see it. Then some of them are just, they go up high based on rock chips, looking at RMI. Some comes back, and as geologists, you can go out on most projects and pick up a high-grade rock chip anywhere you like. And there one there with RMI, 36%, 36 grams per tonne gold, 12% copper, and the shares rocketed up 460%. The others, some applications or new projects have been taken up. Interestingly enough, surprisingly, I guess, is Yari Minerals taking up the Rolleston South coal deposit in the Bowen Basin, went up 200%. So that's sort of the things, a mix of things that have pushed up the various commodities over the last year. Where we sort of focus our reports is on dividing up the announcements into sections depending on what they are. Section A of our report deals with all the projects that are new acquisitions, and Section G with drill targeting, geochemistry and geophysics. Then you get into where you get the retail investment excitement zone. This is the drilling. Drilling, as most of you will know, is the area which generates the higher share prices, with the regular reporting of drill results, which occur in Section E, and also building up into Sections E and D. D is where we put all the resource and reserve announcements. Then after that, we get into the stage that is difficult. And this is one that you'll see with some figures later is really causing some problems for junior companies. You've got a project, you've got a resource, and it all looks good. And then you've got to go through the feasibility, the permitting of the project, financing, and so forth. It can be a long and protracted process. And this time gets very frustrating for retail investors. They lose interest in the project. They're looking for the next drill results. Something you just have to go through, but it is an area that unfortunately is getting longer and longer to get to the point where you can go into production. And then again, the company can create market interest through reaching nameplate of its production. The other problem in permitting, going back to it there, is the fact that the green, red and black tape is not only at state level, but it's duplicated at federal level. And it's very important for governments in Australia, for the federal government to get out of the way and let the states run the mining industry. And then we get legal challenges. You've got the organisation called the Environmental something or other Protection Authority that is holding up projects such as McPhillamys and also Woodside's renewal of its Northwest Shelf operations. But where investors need to keep in mind is the reality is that the more demand for a commodity, the easier it is to get into production. The less demand, the harder it is. There are some exceptions in that, but basically those that for which there's a more demand, things like oil, coal, gas, iron ore, gold, copper, aluminium, manganese, and so forth, are probably a lot easier to get into production than if we go down to the technology minerals. One of the terms that is banned in Austex is this word the governments have racked up and promoters push, called critical minerals. As geologists, there is no mineral that's called critical. They're called lithium, they're called rare earths, they're called graphite and so forth. But this, as you can see, only 3.2% of the companies involved in those projects on the ASX are in production, compared to 15.6% of the gold and silver companies, 12% of the LME metals and bulks, and 21% of the energy minerals. This is sorry, this should read coal, oil, gas, coal and uranium. And that's because these projects get into production relatively quickly if they can actually get tenure and get going as a result of demand. So LME and nickel projects, LME metals, nickel prices have been an issue, but the outlook for aluminium, copper, zinc, tin and tungsten are positive long term. And the nickel prices problem has been largely a result of situation with production of dirty nickel in nickel pig iron from Indonesia. There's a large market, there's transparent pricing, and the processing of to a saleable product at the mine gate is well understood. Energy minerals, the market is large for petroleum, coal, and emerging for uranium, and processing well understood, but there are political barriers, which I think will come down. I think the world is getting sick of this global warming sort of push that we've got to stop putting carbon dioxide into the atmosphere with burning coal and so forth, because mankind, the greenest green and the tealest teal, will not give up their lifestyle, and this is essential to making sure we keep going. So energy minerals will always be there in the mix. Technology minerals, this is the problem. This is a small, what a lot of people don't understand, this is a small global market. Downstream processing is expensive and technically complex. It's Chinese controlled and will require patience and deep pockets to break into. And I think we're seeing that. We're seeing so many of our rare earth companies, we've got Lynas into production, but look at Arafura, Hastings and so forth. Their only way of progressing is through government handouts. And I really question the sense of putting taxpayer funds into any resource project. It really should be funded by the fact of supply and demand. The precious metals, now this is the easy bit. You know, you just basically the exploration's easy, the metallurgy is well understood. You can get off the shelf CIL flow plants. It's easy to mark at the door. You just ring up the LME Mint and tell it's on the way. There's off-takers now for flotation concentrates with gold in them, which weren't around in some time ago. And the smaller, particularly in WA over there where you guys are, smaller deposits can easily be brought into production with toll treatment and ore purchases. So this is the area that you can quickly get something going in a cash flow. And in any small resource company, it's important to get a cash flow going. So how has the share market price varied over the last 12 months compared to the commodity prices? There's been a lot of excitement around titanium as a critical mineral. Well, you know, just up the road from you guys have been mining titanium for a long while at Eneabba. Retail selling, yes, at $2,330 a tonne, but most of these titanium projects we're seeing out there are largely ilmenite projects where ilmenite is selling for $590. So it's not really such a critical mineral as we would be led to believe. Antimony's come into the frame very much as a result of the current unrest in the Middle East as a source mineral for arms, and there's most of these projects have been dusted off. These companies weren't involved in antimony exploration 12 months ago. They were probably lithium explorers and now are antimony explorers. So they've had a good jump in the share price. Similarly, a lot of interest in manganese over the last 12 months. There's a lot of people jumping in on the use of manganese downstream in lithium batteries, with some of the companies looking at setting up processing in the US where the government subsidies are a little bit higher than elsewhere. But you know, keep in mind that the commodity price, the price of manganese has actually dropped 25% over the last year. Bauxite's been a real winner. In particular, very successful has been Metro on Cape York. The share prices for bauxite companies are up 79% on average. Another one that's done very well is this in the Cameroons. But the price of bauxite has come down about 4%. Gold and silver, well, we all know the story there. It's the share prices on average are up 52%. The gold price over the last 12 months is up 45%, and the silver price up 15%. So it's been a real winner. The other real winner has been tin. Tin and tungsten put together. Share price is up 51%, with the highest price of tin up 3%. Also in demand have been lead, zinc and lead, with the share prices up 31%. Rare earths are up 24%. Yes, the price of neodymium, which is the rare earth we monitor, is up 20%. Others there, fertilizers up 23% as the world realizes we need more of these to feed the populations. And then the big losers at the other end have been vanadium stocks down 38%, lithium stocks down 36%, iron ore stocks down 32%. Uranium, despite the fact that we will need more uranium production, is down 32%. Hydrogen, helium just really haven't delivered the promise that they originally offered, down 28%. And cobalt down 28%. Interestingly, oil and gas companies are down 24%, despite the fact that the natural gas price over the last 12 months has gone up 26%. Oil is down 5.5%, but I think we're going to see in the next couple of months a increase in the price of oil, which will drive that up and make oil stocks very attractive. We've already seen yesterday the Middle Eastern Abu Dhabi company make an offer for Santos. So one of the, explorers can't do much unless they raise capital out there. And if we'll have a look at the graph over the last 7 years, it reached a peak of $3.1 billion being raised in the fourth quarter of 2021. Since then, it has declined slowly on a sawtooth pattern. What's the reason for that sawtooth pattern? Is that we see a number of very big raisings. You can see there the blue line is showing the raisings of greater than $10 million, how they go up and down virtually almost every second quarter. Whereas down below the red line, have a look at that. That's $400 to $600 million in sub $10 million raisings that seems to be available on the ASX every quarter. There's competition to get that funding, but it is there. Of the raisings bigger than 10 million during the first quarter of this year, $280 million of bigger raisings were raised for gold by 7 companies, 114 million largely for heavy minerals and some rare earths in 3 companies, 85 million in 2 companies for zinc and lead. Surprisingly, 2 companies raised 50 million between them for lithium, and then other raisings have been for copper and gold, coal and copper. Capital raisings by commodity over the last 12 months, we can see that gold has dominated that situation. Lithium has fallen away. It's had a interesting increase in the fourth quarter of 2024, but then has dropped down again in the first quarter of 2025. Uranium has had its ups and downs as well. It's did well for 2 quarters and not so well in the other quarter. Hardly anything was raised in the first quarter of 2025. Copper, rare earths, you can see rare earths are dropping. Copper is also up and down, but the increase there in heavy minerals is the fact that people are looking more now for titanium as a so-called critical mineral. And lead and zinc has also increased in the capital raisings for those commodities over recent time. Average cash held by ASX companies as of, that hasn't been updated. Average cash as at the end of December. A lot of money was raised for uranium companies, which was whittled away. A lot of those companies that it was raised for were companies that were heading into production, such as Paladin and others in that have got advanced projects. Gold, the average cash is lower because more of it is being spent on projects at the time. Graphite, largely the reason that a lot of money was raised for graphite companies, but they haven't been able to spend it because basically there's bugger all market for natural graphite. So much dominated by the synthetic graphite market. And then the others you can see there, the amount of cash held. The average there is probably somewhere around $6 or $7 million is held on average by ASX listed junior resource companies. Exploration expenditure also has fallen since 2022, where it reached a peak of just over $1 billion a quarter, and it's down to 635 million in the first quarter of 2025. There's some talk that it will move back to those old pre-COVID levels of around 400 million, but it is declining, the amount of exploration expenditure, and anyone in the drilling industry will tell you that that certainly is the case. Total exploration spend by commodity. Again, gold has dominated it, particularly in the last couple of quarters. Lithium is reducing. Oil and gas has been reducing. Copper has maintained fairly steady. Rare earths has come back in the last quarter. Uranium the same. Nickel the same. And the other commodities there are listed. Again, if we divide the exploration expenditures greater than 10 million with those less than 10 million, we can see that both of those graphs are coming down. So the expenditure by greater than 10 million has been averaging around $700 million a quarter, dipping down to between 500 and 600 million in the first quarter of 2025. And whereas those smaller ones, hang on, no, I'm back to front, aren't I? Sorry, the small companies have raised 700 million, or smaller expenditures, companies doing smaller expenditures under 10 million, but those above have dropped away. Both of those are declining. Exploration expenditures greater than 10 million in this year have largely been gold companies and oil and gas companies. So if we look at the expenditure on exploration and we look at the staff and administration costs in exploration company, we see the real impact of red, green and black tape that governments impose on companies. In the table on the other side, there's a calculation of exploration over administration and staff. Now, some of those staff costs, we can't tell from the cash flow reports that are put in, but some of that staff may be technical staff, some of it may be administrative staff, but we just really don't know. Whereas exploration will be outside contractors, drilling contractors, geophysical contractors and consultants and so forth. But that's gone from over $2 spent on exploration compared to $1 on administration and staff in 2021, down to last quarter where it was only $1.19 on exploration. So we're spending nearly as much on administration and staff as we are in actual contract exploration. It's just falling away gradually. And that's the impact of the time it now takes to actually get approvals to do something. Yeah, and we see it in our reports. If we look at Section E reports, now these are the ones where drilling results are actually announced. So actually you've got the assays and the announcement comes out. In a full calendar year, they reached up close to 1,800 in 2022, and dropped away to 1,300 in 2024, which is reflecting the different levels of expenditure that we're seeing on exploration. Year to date, January to May only, has also dropped away, except it seems in 2025 to be at a similar level to 2024, which is good news. So we are seeing quite a lot of drilling announcements coming out this year, or more on average, but it's not the peak of exploration that we saw in 2021 to 2023. And another question is IPOs. We saw a peak of these of about 200 of these in 2021, and again it's drifted away to where there was been very few this year. It was good to see that yesterday there was a bauxite company got listed, or actually it's in today's report, so it'll be out tomorrow morning with us. But there was a bauxite company that listed today, which is great news. The number of juniors has reporting is declined from a peak of 780. These are the companies that do put out a Appendix 5B report, which is about 87% of all ASX resource companies, down to the number with administration costs greater than exploration is rising too. This is a worrying thing. These are companies that are spending more on administration than they are on exploration. It's currently 32%. It was at one stage only 13%. Numbers with less than 1 quarter cash. We have 14.5% of companies with less than 1.5 one quarter cash. So 14.5 of our companies will be looking to raise capital in the next quarter to stay in business. But somehow the money seems to be there and they seem to be able to do it, pick up a few million here and a few million there. The minimum was 13.2%, so it is a little bit higher than it has been over the years. So you can see 700 companies, 200 of what are expending more on administration and exploration, so it's a pretty significant number, and around 100 have less than 1 quarter cash. So all things to talk about. Looking at gold production and the cost of that production over the last 4 quarters. I use this because we do have quite a number of ASX gold producers, and it's a pretty simple cost that they have, the AISC cost per ounce, a way of melting those. And if we look at the second quarter of 2024, production was an average of 75,000 ounces at 2,116 Australian dollars per ounce. By the first quarter of this year, it had dropped slightly to 63.7 ounces per company on average, and the cost had risen to 2,438. The companies that have decreased their cost over that period of time are companies like Carpentaria, CMM. I'll just read out the symbols: GMD and BCN have reduced their costs by 26% over that period of time. So they're starting to get in sort of improving in the case of BCM, improving a difficult situation that they were in. But the costs have gone up quite significantly. AMI in the Cobar Basin has gone up 50%. The costs of emerald in EMR in Cambodia up 63%. Northern Star up 24%. Alcan in Tomalin in New South Wales up 48%. BGL, which is on Bellevue, up 65%, and so on. So it's a pretty good indicator that the inflation rate in these companies is an average of, sorry, we'll go back. I can't, it doesn't matter. All right, so it has gone up about, there we go. Sorry, it's gone up about 20%. So that's a real inflation rate within the mining industry, we think, over the last 12 months. So the costs have gone up of production generally, and probably costs of exploration and so forth for what is actually being achieved. Looking at gold producers, their market cap per ounce of gold, the average is about $300, which is unchanged of recent time, and which is a significant price, with companies like CYL and RMS and GMD being valued the highest. Smaller producers like KSN, ALK, and SMB are the cheapest per market cap, or market cap per ounce that they actually produce. Actually, there's two lists there, aren't there? Sorry. Yeah. So, sorry, I'll just, yeah, that's right. So the cheapest per market cap per ounce, KSN, ALK, and SMB on the left-hand side, and the most expensive EMR, sorry, the highest per market cap per ounce are EMR, GOR, and OBM on the bottom right-hand side. Sorry about that. Looking at 48 Western Australian gold resources not in production. Now, keeping in mind that those in production averaged 300, those not in production are averaging, if they're in WA, about $170 an ounce. Now, if they're in other Australian states, they're averaging about 108. And the difference in the valuation is the fact that if you've got gold deposit in WA, you're not too far away from a gold plant, and so therefore you can generally get it processed reasonably easy, whereas in the eastern state that luxury is not around. In fact, Western Australia is the only place in the world where that actually is possible. You've got the contractors set up and the toll treatment set up, and it's fantastic. If you've got 50,000 ounces, you can turn it into money. One of the most successful in the last 12 months in doing that is a small company called Auric, who have been mining out in the Norseman area. Other Australian states average about 108, and if they're overseas, about 58%. $58, sorry. I'm dealing with a situation in Iran right now with my mother-in-law, so I'm actually, sometimes my concentration is dealing away, trying to find a solution for her. As you know, that's pretty difficult in the Middle East right now. Other states, gold resources not in production, as I mentioned, are averaging around $100 an ounce, with the cheapest being what LGM have in the Drake area, 32, and the most expensive being LRV at Hillgrove at 318. Overseas, BDG, that's a big deposit, 1.5 million ounces in the northern part of Spain. Talking to the guys there, it's pretty difficult. It's where all the rich people in Spain live, and so it's pretty difficult. So the market cap per ounce there on that massive project, only about $8. Going up to Tolokuma and PNG TOK, which has got a market cap per ounce of 186, probably overpriced given that you need to get in a helicopter to fly in there. A selection of recent coal deals. RMS are offering or paying $841 an ounce for SPR. Goldfields $708 for GOR. Northern Star paid paid $377 for DEG, and AAR paid $92 an ounce for MXR. Down in these were company takeovers by project acquisition. They're a bit cheaper. The M16 at Bullabin is paid $72 an ounce, and Henty KUAU paid $67 an ounce. So market cap in listed companies, again, $330 for WA. Not in production in WA, $170. Resources in other Australian states, $108, and overseas resources, $58 an ounce. So that's probably a bit of a rundown. Sorry, it was a little bit disjointed this morning, but while we've listed the factors taken into consideration, resources are an ever-moving, complex market for which there's no single answers. So we just invite you to get in touch, and if you'd like to receive a copy of our report. We're old-fashioned. We don't have any data on the internet, so it's not like something that someone can scam or get. You have to actually send us an email, and we will send you our reports by email. Thanks very much for the opportunity to talk to you, and I hope you have a great day there in WA.